want to take some time now and show you how the family banking system works. So these next several slides in this video are going to show you exactly how the system is designed to help you acquire and purchase items that will help you financially. So we have condensed everything to go through a 4-year time period, and we'll explain a little bit more about why that's important for you to understand as we go through. In year 1, we are assuming that we have already identified the wealth transfers in your life and created greater financial efficiency for you, so that you have now accumulated $30,000. For some of you, it may have taken a little longer than others, and the family banking system can begin to work whether you have a lump sum of capital initially or not. But this is assuming that you already have the $30,000 necessary to purchase the car that you want to have. And so what we want to do is shift your paradigm so that you're thinking more like a banker. What does a banker do? They loan money out, and then they recycle all the payments. And that's essentially what we're doing in this particular example. So we have the $30,000, we're going to purchase a vehicle, and in this particular case, we're going to amortize it or create a payment schedule over 4 years at 6% interest. Now, we want you to understand that we recognize that very few people would finance this $30,000 car over a 4-year period of time and create a $700 a month payment. This is an example to show you how the family banking system works, but the actual terms of how you set this up are entirely up to you. You can pick the time frame and the interest rate. It's always better for you and your family banking system to charge yourselves at least market interest and maybe a little bit higher. And in subsequent videos, we'll show you why that's important and valuable to you. But in this particular case, we've created a $700 a month payment, which creates $8,412 per year coming back into your family banking system. So we start with 30, we will pay cash for the car, and into the first year, we're going to put $8,412 back into the account. At the end of year 1, we've got the $8,400, and beginning of year 2, we decide we're going to purchase, in this particular case, a home entertainment system. It's $8,000. We're going to set up a 3-year or 36-month repayment period at 10% interest. Again, that's an arbitrary number. You pick the number. We encourage higher interest rates, at least 10, maybe even 12%. That creates a $256 a month payment, or $3,072 a year. So over the course of the next 12 months, we're going to put our car payment back in, and now we're going to put the theater payment back in. So we have a total at the end of year 2 of $11,896. At the beginning of year 3, we determined that we would like to have this fishing boat. Now, I'm not sure you can buy this particular boat for $11,000, maybe the motor possibly, but nevertheless, we're going to take $11,000, amortize it over 2 years, 24 months at, again, 10%, and that creates a payment of $503 a month, or $6,036 per year going back into our banking system. So once again, we're starting the year out by paying for the boat. We pay cash for it. Now we've got $896 on our account. We're putting our car payment back in. We're in the 3rd year of our car payment schedule. We're in the 2nd year of our theater payment, and now we have our boat payment coming in. That's a total of $18,416 at the end of year 3. At the beginning of year 4, we decide we're not going to purchase anything else. We're just going to continue to make our payments. And so we have the $18,416 on our account. We have the car payment, the theater payment, and the boat payment. So at the end of year 4, we now have $35,936 in our family banking system. But we now also, because of the recycling of money, we have used $30,000 to acquire or finance $49,000 in goods and services, meaning we leveraged $30,000 into $49,000. In addition to that, we've recovered $35,936 in principal and interest that we would normally send to another finance company, a bank, a credit union. And we now own free and clear a car, a boat, and a home entertainment system. So when we look at this picture in totality, is that we have begun to think like a banker, and we have recycled our dollars and utilized them in the most financially efficient way that we possibly could. So we now have more assets than we started out with, we have more money than we started out with, and we have these assets free and clear. Now, had we have used traditional financing, the payment schedule that we set up would have paid $33,648 for the car, $9,216 for the theater, and $12,072 for the boat, for a total of $54,936 in total payments, which would have left your checking account forever. And you could have never earned interest on those dollars again. This is what's so important about one of the most important things about this process is that had we have sent the payments to another financial institution, had we used traditional financing, we would have spent nearly $55,000 on these items, and we would have never been able to earn interest on that money again. Yes, we had the items, but we don't have the money, and we don't get to earn interest. But the bank does, because that's what banks do. And so we want to shift that paradigm so in the future, you have the money and you have the assets, and you get to continue to earn interest on those dollars instead of the bank. And this is why we want people to understand why it's so important for families to create and start their own family banking system. Hopefully this has been helpful in helping you understand how the family banking system works, and we look forward to helping you implement your own family banking system.